We are Mortgage Pros 411. I am Audrey Boissonou, and this is my co-host Kevin Casey, and we are here with the amazing Julienne Joseph with FHA. I always have to make sure I don't throw an extra H in there and mess up the whole thing, Julienne.
No problem. No problem.
So Julienne just got a big promotion in the last few months. Now, one might think this would make her, a little more full of herself. But no, she's still the amazing, wonderful person that we love, who will tell us all things that are truth. So you are directly connected to Head Secretary Marcia Fudge now, right? You're her advisor?
Yes, I am.
The reason that I highlight this is so that people can take solace and comfort knowing that somebody who is bright, intelligent, and actually cares about the consumer is in the ear of our head secretary. So woohoo, I'm so happy about that.
Great. And it helps to have a secretary that is also so rooted and invested in not only helping consumers, but also making sure that the mortgage industry is healthy, right? So there's a dual objective there. So the fact that she's able to understand the need to do both makes my job extremely easy.
So she's so nice. Yeah, I don't know her at all. I've never met her.
Oh, she's amazing. To know her is to love her. She's amazing. Absolutely.
So that means you're 1 degree separated from Biden?
I don't know about those degrees. Look, I don't know. I say is I serve at the pleasure of the president, and I serve under the leadership of the Honorable Marcia L. Fudge. And I'll leave that.
Beautiful.
I just trying to figure, because that makes us 2 degrees separated.
Oh, he's just trying to connect himself. Back off, buddy. Good God.
Yeah, definitely not at 6 degrees, Kevin. We are so much closer than 6 degrees.
Yeah, not 6 degrees. But I used to think every time I go to England that I was going to have tea with the Queen, and that never happened. So anyway. All right. I just want to take a moment and talk about an event that we will be in tomorrow, the next day, the 14th through the 16th in Anaheim at the Anaheim Hilton. It is the California Mortgage Bankers Association, and they are having their Mortgage Innovators Conference. And it is an action-packed agenda, kids. So I know a few people that are going, but if you are thinking of attending and you would like a discount code, guess who has one? That's right, we do. Don't ask me what it is at the moment because I can't remember. But if you text me or call me or email me or do something, I will give it to you.
Email Audrey at mortgagepros.411.com.
Yeah, it's probably better to call me or text me, but yeah, do that. So anyway, so we're really excited about that. We're going to see some of the speakers who have been on our show, but we haven't met them before. And maybe we're going to find new people to talk to. So that'll be exciting, right? All right, so there are a few things going on, Julienne, before we get into it. First of all, we had CPI come out today. Hallelujah. We have been waiting for this number.
Nice number.
Right? I know. So the headline number is now 4% year over year. It's down from a peak of 9% a year ago. So good Lord, or a year-ish ago. That's a big deal. I mean, we'll take it, right? So of course, there's always a million different nuances and all that. So we've got core CPI and we've got headline CPI. So is the headline CPI that was down to 4% year over year, and it was only up 0.1% month over month, which is a big deal because it's replacing bigger numbers from last year, which is why that number's coming down, the headline number. Core CPI is slightly more persistent. It was up 0.4% month over month. It's down year over year from 5.5% to 5.3%. So it too is getting better, thank God. You've got used cars, and of course, I always learn something new. I didn't realize car insurance was also included in these numbers.
Oh, really?
So, yeah. Did you know that? I did not know this. So 3.36% of core CPI is used cars, and 3.26% of core CPI is motor vehicle insurance, and it isn't cheap. So those are having an impact as well. And I just find it fascinating. I'm always fascinated by this. So with all that, tomorrow we have PPI, and the Feds will be wrapping up their meeting. They're meeting right now, and we'll have the Fed meeting minutes tomorrow afternoon. And so PPI tomorrow, which is wholesale inflation, Fed meeting minutes, it's going to be quite the week, kids. And then on Thursday, we have retail sales. So keep aware because it's never a dull moment, right?
Never.
Right. So it'll be interesting to see what the Feds do tomorrow. 10 meetings in a row, they have hiked rates. 500 basis points, 5%, just to be clear, since last March, which is crazy. So they're either going to skip or pause tomorrow. Would you like to know the difference?
Actually, well, it's going to be skip.
What's the difference, Kev? Let's see if you
pause means they're holding tight for quite a while. A skip means we're going to think about it, come back to you next month.
Okay, he's got the skip 100. He's got that totally nailed. Pause is slightly different. It's when they see that there's been a change and their next move is a cut, is the interpretation that I got. But I'm impressed that you knew skip. That was a good one. Did you know all this, Julienne?
Somehow I pay attention. I don't know why.
I bet
I would have taken a similar guess. I would have taken a similar guess with Kevin. If not, I would have as a friend.
Yeah. I mean, all in all, things seem to be getting better. I mean, mortgage-backed securities are 150 basis points better than they were a couple weeks ago. That's a big deal, just in case you haven't noticed. Just in case you've been out slacking off, which I know a bunch of loan officers are doing. Probably not the amazing folks on our little call, but yeah, that's the biggest problem that we have right now is slacking loan officers. So let's talk to Julienne, who is looking lovely, and your shoulder is all repaired. You're all better.
Yes, I'm much better. I had shoulder surgery, guys, 30 days yesterday, but wow. I won the mend and I feel great. I had a rotator cuff tear, and but I'm healing well and I feel great. So no sling for me.
Too many games pitched.
Listen, you should see the other guy.
Game pitch count there when you were pitching baseball.
Did you hear what she said? You should see the other guy.
Should see the other guy. I mean, but no.
Awesome.
I wish I had a super exciting story. Just working out too much weight and I felt it pop, and that was how it.
Oh, good Lord. Yeah, I've heard shoulders are so painful. So anyway,
I'm glad to be here with you guys.
This is okay. So let's just dive right into what everyone always wants to know about, which is any thoughts on the life of loan mortgage insurance and whether that's going to stay or go?
Yeah, and that's a great question. We do get that question regularly. The last time I was with you guys, we were exploring the cut, and we were trying to finally get to one. And I was kind of explaining to you guys what was going into the calculus of where we would eventually land. So we really wrestled with this because we know that the perception of life of loan is that it would serve a huge portion of the market, was what we were anticipating. But when we actually did our analysis, when we were trying to determine, how do we go as deep as possible in helping borrowers as opposed to wide? And we wanted to make sure that we offered the deepest cut possible. So what the data was basically saying to us is that, 82%, between 82 and 84% of our endorsements last year went to first-time home buyers. So everybody knows we're pretty much the first-time home buyer program. Some people think that FH and FHA stands for first-time home buyer. People have actually...
Oh my God, I never thought about that. Tape makes sense, though, doesn't it?
I mean, it makes sense because, that is pretty much who we serve. But with that being said, everybody knows that the majority of first-time home buyers don't stay in their homes beyond 7 years. So when we were saying, okay, if we have X number of dollars that we have to work with here in order to do a cut, we didn't want to necessarily use the portion of that on cutting life of loan, because again, at the end of the day, it comes down to, to credits and debits when we were looking at it. Mm-hmm. And life of loan is revenue for us. That's just being candid. But when we said, okay, if we wanted to be able to offer the deepest cut possible, if we would have done that for such a small cohort of the actual book, it would have impacted our ability to do a deep cut for the majority, for every borrower who would have originated, but it would have only benefited a handful that actually stayed beyond 7 or 8 years to benefit from the actual cut. When we did the estimate, it would literally take about 9 years for a borrower to be able to hit that 78 to 80% benchmark for it to have fallen off. And not enough borrowers at FHA keep their mortgages long enough for us to justify, it wasn't enough juice for the squeeze for us to hurt everyone and not do a deeper cut for that handful that might stay beyond 9 years. So we had to make the decision. And, if we would have gone with life of loan, we definitely wouldn't have been able to get to 30 basis points on the cut if we would have done that.
No, that's probably because a lot of people will call those FHA borrowers after like 5 years and say, hey, get you away from that premium payment and put you into Fannie Freddie and get it done. But
And and also, because a lot of that that conversation comes from the conventional market, of course, right? Mm-hmm. Because it drops off there. But you got to understand that we're an insurance company. So the way that the GSEs operate isn't necessarily how we operate, because we're government-backed programs. So right. Of course, the mortgage insurance drops off over there, but also the lender is on the hook from 80% and beyond. Whereas with us, with life of loan, literally the lender is protected for the life of the loan. So there's a little bit of difference there. And also, we don't price for risk. So at the end of the day, at FHA, the price that you have at, a 680 is the same price that you have at an 810. So we don't price our mortgage insurance or our rates for risk. So when you kind of compare, when you're looking at it apples with apples, an FHA borrower that might be at a 620 that has, the rate that we have in the mortgage insurance that we offer at a 620, it makes more sense given the fact that the rate is likely lower and they're not keeping the mortgage until, like we just said, they're not keeping the mortgage, to the point that they would necessarily pay 20% down on the mortgage. So with that being said, it tends to be more affordable for our lower credit tier band borrowers. It's still more affordable for them than if they were to take their 620 to the conventional side, where it could be more expensive for the actual rate and for the mortgage insurance.
So without getting into a, how shall I put it? We don't want to go deep into the differences between FHA and FHFA, but I would argue that they're not really risk-based pricing anymore either, because no one will show me their algorithms and nothing makes sense over there anymore from my perspective. So we
love our friends over in the conventional space, though.
Of course. Listen, we want them to be, we want all things to be good for the consumer, right? And so we are always watching very carefully and wondering, how is this all shaken down, and how's that helping the borrower? So with that being said, to be clear, the life alone is not being considered at the moment because we got the basis points dropped on the monthly, which is better for the consumer, since 82% to 84%, just to be clear, are first-time home buyers who won't stay in there longer than 7 years. So we're good. Is that it? That's it? Should we stop talking about this?
And I will say this, the cut that we were able to provide is going to impact about 850,000 borrowers this year alone. Wow. Which will save them about $800 a year on the average for the average borrower. Right. So, just considering the fact that we're going to be able to help as many borrowers as we can with the cut, we feel like we landed in a good place where, everybody could kind of be happy with what we were able to do.
I feel like that explanation, though, made so much sense, because we kept thinking, oh my God, this life alone is so bad. It's so bad. I didn't realize that, to the extent that, okay, yeah, we knew it was for first-time home buyers. I didn't know it was that many. And also that statistically, they're not staying there long enough for that MI to drop off anyway.
Yeah.
Now, is it they're not staying there long enough, or they're not staying in the loan long enough?
Well, so, or if they do get to that point where, because, and also, there really isn't a refi market right now either. Right. So, what we will basically see is either people will move on to the next home, because again, right. It's they're selling, not refinancing. The majority of our borrowers, their first home is not their forever home. So usually the first time home buyer, within that 7 years, somebody's getting married, somebody, has a promotion or a new job, somebody has to relocate. And even for military, because we do, loans for, veterans as well. So what we're seeing is that usually within 7 years, life happens. So people usually move to adapt to whatever that significant life change is, because most of our borrowers are so young that first home, they usually want something either bigger or better, and they're ready to move on. And usually that happens within the first 7 years.
Do you know what the average age of your first-time home buyer is? Because the average age overall is 36 at this point.
Yeah.
I think it's younger for FHA.
Yeah, I think it is. I think we're somewhere, and don't quote me on this, but I think we're somewhere between the 30 and 35 band is kind of
right in the middle of it.
Yeah, I think that we're kind of in the middle there. And I think, in the previous administration, I believe that the age was about 35. I think, but with the significant changes that we've done to the student loan debt calculation, that's helped us ease some of that pressure to bring the first-time home buyers with student loan debt back over to us. And I think that has helped lower our age a little bit now that we've readjusted the way we look at student loan debt.
Interesting. Well, we were talking a few weeks ago about a number where, okay, I always get mixed up. Gen X, who's the cohort right now? The younger ones, not me.
It's interesting.
Below millennials, they're buying houses.
Yeah, I mean, it's interesting. We literally, we could talk about this. I see that somebody asked about supply in the chat already about questions. And we, over the weekend, I don't know if you guys heard about it, but we had our innovative housing showcase on the National Mall in DC this weekend. And we had a house party 2.0 with the secretary, which was really cool. But we're really pushing manufactured housing. And also we co-hosted that with the National Association of Home Builders. So we're, we partnered with them for that particular event over the weekend. But I would say that there were so many millennials that were out there that are interested. I think also what we're seeing is still that appetite for the smaller tiny homes. We're starting to hear that as well, because a lot of the millennials are interested in not taking on a lot of debt. So they're trying to find the most inexpensive or the most affordable way in order to address homeownership. So we're seeing that desire for, I don't need bigger, because bigger means more maintenance. So we're seeing still that interest in like the condo approach, or looking at, maybe my family does have land, and instead of me building something that's huge, let me just go ahead and get a tiny home that's 400 square feet and I'll do that, So we're seeing appetite for home ownership. I think that, but what we are seeing is that they want low maintenance. And I think that as long as they can find a property that is easy to maintain and is affordable, they're willing to dip their toe into it. One of the other things that I did during the Innovative Housing Showcase was did a Mythbusters section. I literally covered the 5 myths that are keeping young people from wanting to even buy a house. And, because a lot of the reason why millennials don't want to jump in is because they are the children of the parents who lost their homes in the housing crisis, right? So they're hearing, mortgages were bad and banks were not safe and they just want to take your house. So, I wanted to address, one, let them know that, that fear is legitimate. I mean, if you're seeing that people were losing houses, now that you're of age to start doing that, it's kind of like, I'll just rent forever and at least I know what I'm paying. But with that being said, I wanted to address those things and brought up how we were able to help, over 2 million borrowers save their homes during the course of the pandemic. Like, nobody knew what was going to happen. We thought another 2008 was imminent, and we curved that. And I mean, when I mean curved it, we curved it hard and didn't even get close to the cliff, right? So I wanted to let them know that the mortgage and the housing market of 2008 that they grew up in is not the market that we're living in now. We have way more resources and tools to help them. And plus there are more resources there to prevent them from even getting close to that level of desperation, right? So, I wanted to address those things, not only from getting approved, but also the resources that are in place, like housing counseling, and forging those relationships before you actually get into a contract. And then if you do get in trouble, you've already established a relationship with a HUD-approved counseling agency that can help you with your options. And I let them know all the options that we've had on the table, which I'm sure we can talk about that too, what we're kind of working on there. But to answer your question, I think that we have to address the fear for millennials, because there's so much information being thrown at them. And now they're hearing, okay, the rates are extremely high, which gives them anxiety, right? So they're like, oh, am I getting a bad deal that, going to do this? But I was like, listen, this is what the rates were before the housing. We have just been in an extremely low interest environment for an extremely long time. But I was telling them in the 80s, it was in double digits. Like my parents were at 12% in the 80s. Like
my first house was 10 1/8. And I thought that was a sweet smoking deal.
So, Julie, you and I are too young to remember that, but Kevin vividly remembers it. So there's that.
The fact that you believe that I'm too young.
I know you are. I know you are.
Don't look at these braids here in the hairline, but yeah.
Actually, historically,
that hair is beautiful, beautiful.
Historically, a 6% interest rate is a refinance boom in the mortgage market.
Right.
I remember,
just not this time.
Yeah, this time. When I was originating. Yeah, when I was originating in 03, 04, we were here. It was 7.5.
Yeah.
Oh my God, 20 years ago. Yeah.
And
Okay.
people will say, oh, the loan amounts were smaller. Yeah, but your salaries were smaller. Everything was, you know what I mean? It's all proportionate. And so again, with inflation coming down from 8 million% to 4, we're doing better. It's going to get better, people. Okay. So were there any other points that you covered this weekend that you would like to share with us?
Yeah. And I mean, and a lot of this is just because, you know, you guys are family and I'm singing to the choir, but there were people out there who believe that they still need 20% to buy a house. And I was just like,
biggest lie out there.
It's crazy. Where does it come
they really
from? I don't know.
And I use the phrase that, you know, your family and your friends are loud and wrong. Like, no, that's not the case, because it might have been the case for your, you know, grandma when she was buying in the 80s that she needed 20% down, but this is not your grandma's loan. So I let them know that, you know, the minimum requirement is 3.5%. And we do allow down payment assistance, that 40% of our endorsements have some type of down payment assistance associated with them. We also talked about that they can do more than single family detached, because some of them don't think that they can buy 2 to 4s with an FHA mortgage, but let them know you just have to occupy one of the units. They didn't think that we still had a rehab program, a 203K, but as you guys know, we did an RFI, so we're working on rehabbing the rehab loan. So hopefully there will be some good things that come out of that, perhaps raising the amount for the streamline and get it higher than 35,000. So there are some things that are going on there to try to make it more attractive too. But we were addressing tons of things, but and we also, you know, hit student loan debt again, that if you have student loan debt, look at us again, because if you've been denied, you know, in the last 3, you know, before the last 2 or 3 years, come look at us again, because now we take the actual payment and not the 1% multiplier. So now that that's there. So there were certain things that we were trying to share with them to kind of get them off of the fence, to make them feel a little more comfortable about getting approved.
So we have some questions coming in from someone who is asking about a bunch of stuff that applies to FHFA, not to FHA. So I just want to clarify, you're with FHA, and we won't be talking about FHA, FHFA.
Well, I used to be with FHA, but I'm now over, you know, I advise her on all things homeownership. But yes, I am an alumnus of the FHA HUD world. But yes, but I am not FHFA. Those are our friends across the street.
That's right, exactly. So all the questions about LLPAs, et cetera, those aren't going to be applicable here. Someone will comment that their VA loan was 14%. Hello, can you imagine 14%? Yeah, he was probably happy about it too, right?
Sounds about.
Yeah, exactly. Okay.
I had a question on one of the programs you mentioned on the 2 to 4s. So what I think it's one of the best programs is a 2-unit program, where you get to buy a house and you get to use the rental income on the other house. And I help people all the time. I say, listen, buy a 2-place where it's like a single family home with an additional unit's been added in the back. Go live in the back, and then rent out that big house in the front, and it's basically paying your mortgage. It's like a big jump. Any chance that they would ever consider expanding it so that you can use the rent from a 3 or 4 unit building?
Yeah, you can use the prospective rent for a 2 to 4. So if you do have prospective rent, you can. And also we have something on the drafting table as well about ADUs right now, because we expanded it, the 2 to 4 prospective income from the 2 to 4s to apply to ADUs too. So that rental income can also be used for a borrower who has an ADU that's already attached to the unit. You can use that income as well if you can if
the coming out. Do you have any idea?
It's on the drafting table now. So we put it out there for feedback. So please go to the single family housing drafting table. The mortgagee letter is out there for you guys to respond to now. But yeah, we're floating it just to see if you guys have any.
Is this a similar program that your neighbors across the street they're promoting, where you can put out 50% of the rent instead of 75%?
Yep. So we're looking at the haircut. And I think the thinking behind that too was the fact that there's very little data on ADU market rent. So what we didn't want to do with us coming out of the gate is start with 75% when we don't really know how the market will respond, where the market really falls, especially when you know that there are only concentrations of ADUs like in California, they're in New York, that's where they really are. And there's just not enough data there, that we wanted to start a little more conservatively on using projected income on ADUs and then move from there.
It's not just limited though to the states that have legalized ADUs.
If it's an eligible ADU, and right now we don't finance the construction of ADUs yet. You can only do it as a rehab with a 203K. Right. So that's the only time that you can do it if it doesn't already exist. You have to add it to the existing structure. It has to be attached to the primary structure in order for the ADU to be financed with a 203K. But the only way to do it right now is through the 203K.
You mean attached, like physically attached, like it's touching the building?
Like a garage, a sunroom, a suite, but it has to be literally flushed against the primary residence.
Why is that?
So it also right now, only because we can't finance it as a separate structure, but us doing it as a renovation means that it has to be attached, because we can only use it for 203K because of statute. So the only way that we can do it is if it's a renovation loan, because you're renovating the primary residence to create a unit. If we didn't do it, we would have to have some other financing vehicle, because technically it wouldn't be a rehab because it's not attached to the primary.
Oh, I get it. Okay, the rehab. Okay, that part I get it. I would just say, okay, first of all, I've had a couple of borrowers who they built an ADU in their backyard and then moved into it and rented out their front unit. So just know that that's happening out there a lot. And I think
right now,
I think the messaging from the ground, which is where we live, is hurry, because we could really use the ability to use those rents. That would be really beneficial to the borrower. And does it require a statute change to make it so you couldn't have, at what point can we use the building in the backyard? The she shed that they maybe, insulated or something. What needs to happen to make that work?
Well, we're kind of looking to see if we can use Title I in order to do that, like the manufactured housing, to see if that's the avenue that we can use, which is a rulemaking that we have ongoing right now. So just fingers crossed, and hopefully we can get that done. Because I think that the word right now is structure in the rule. We need to change it to residence. I think that is literally the change.
Okay.
And we're working on getting that out. But, rulemakings take a little bit longer than, actual administrative changes, because we got to do public comment and all of that. So we're thinking that if we're able to make that tweak, we'll be able to use Title I financing. So fingers crossed, that's what we hope, in addition to manufactured housing, that we can use Title I in order to finance construction.
Will you keep us posted on that? Let us know when that.
Yeah, that's a big supply. That's a huge supply conversation, but that'll also be a good alternative to chattel financing for manufactured housing. We want to just see what we can do in order to make that happen. So.
Oh wow, interesting.
Yeah.
Okay, so let's talk for a moment. Just delinquencies come up occasionally. Your delinquencies are getting better, not worse, right? Yeah. So to anyone who thinks there's a foreclosure wave coming, talk about that.
Oh, no, Realtor.com.
I know.
It said foreclosures are spiking. That's what Realtor.com said just 2 days ago.
Well, that's like, okay, I'm going to behave.
It's the same day that CoreLogic, using the same data, said that delinquencies are all-time lows. So who knows?
If you go back 3.5 years of us doing this little show, we have been preaching since then. Do not read the headline and take that at gospel, as the gospel truth. And for God's sake, if you're going to choose between CoreLogic and Realtor.com as far as a data source, it's CoreLogic 100% of the time. Okay.
Well, CoreLogic is a data source. Well, I'm pretty sure that, because Realtor.com would not have the foreclosure data they would have gotten at one point.
The headlines are, just headlines. Good Lord. Anyway, okay, back to delinquencies, my dear.
Okay, so I can speak from the perspective of our homegrown numbers for our FHA borrowers. So at the height of the pandemic, we had about 835,000 borrowers in forbearance. This was I think that was July 2020. That was where it spiked. So 835,000. So as of April, that's our most recent data, 102,000. We have gone from 835,000 borrowers down to 103, close to 103,000 as of April that are in forbearance. So I think that we're comfortable with what we're seeing, but we are continuing to work. One of the things I was sharing with Audrey before we came on is just some of the things that we're doing. Again, we use the drafting table for everything now, because everything's consequential. You want to make sure that what you roll out, it's right. There's currently a proposal on the drafting table for loss mitigation, because we're talking about this high interest rate environment. Of course, the majority of the people who are delinquent right now got their mortgages 2 years ago when the rates were at 3.5. So to do a modification for them today at 6.5 or 7 is taking a horse for a walk. Like it's not, they're not going to get any savings.
Right.
So, we were trying to figure out, how do you help people have an affordable mortgage payment without having them pull their mortgage from the Ginnie pool at a safe 3%, but having to modify them at 7. So how do you
hang on.
Yeah.
I can stop you there because I want you to, most LOs do not understand how it works on the back end. Okay. So explain how someone's in the Ginnie pool and how, if you are going to mod them, you have to take them out and tell them what happens. Okay. Just keep it simple.
So after the loan is closed and FHA endorses, or you guys have the ability to endorse them yourselves, it then goes into a security over at Ginnie Mae. And of course, Ginnie Mae holds the pool for all the government loans, not just FHA, but for VA and USDA as well. So what basically happens is they hold the security for, however the loan, for the life of the loan. If it doesn't refinance, they at the original rate, right? But what is happening right now is that people can't refinance because the rates are too high. But the same reason that you don't refi is the same reason why modifications on the servicing side is difficult, because in order to modify with Ginnie, you have to go get it from the swimming pool. Let's call it the swimming pool. You got to pull the loan from out the swimming pool, but then in order to put it back in, you have to put it in at today's rate. So you're going to pull a 3% loan out of the pool and say, okay, well, let me see if I can save you with the rate out here in the market, but the rate out in the market today is 7. So I don't want to put you back in a pool at a more expensive rate. So what we're trying to figure out is, how do you keep people in the pool with their 3%, but supplement their payment while they're having the hardship? So what we've come up with right now, and what we're proposing on the drafting table, is to use the partial claim to supplement the payment for a certain period of time. So you take the partial claim and then divide it over a certain number of years monthly, and then just piecemeal it and make a supplement to the payment and help get payment reduction that way. That way the people—
Interesting.
Explain partial claim briefly. Okay,
so partial claim is a 0% deferred loan that's put on the back of the loan that's paid off when a borrower either sells or refinances. So, or you can use it for that. I wouldn't rest, we don't have a refi market, but typically it'll be when a borrower sells their property is when they then have to resolve that. But it's a 0% deferred interest loan that's put on the back to cover any arrearages from any delinquency during the course of the loan. And that's usually what has helped borrowers who have been in situations where, for example, they had a temporary loss of income, but they can afford the mortgage. So what they would do is stop chasing a rolling 90. Like, they can pay it, but they're like, this 90 days that I wasn't working is just this cloud over me. So what you would do is use the partial claim, put it on the back of the loan, and literally start fresh the next month. And then once they sell the house, they'll pay off with their proceeds whatever that 0% deferred loan was on the back. So what we're proposing here is that you take the partial claim now, but take it and divide it over, let's say if it were 5 years, 60, and then take that and add it, and the servicer will apply that to principal and interest every month. And that way it'll provide the savings for the borrower without them having to go to the pool and pull it out and try to refi it to lower it by using the rate. So that's kind of what's being proposed, because most of the borrowers that we're seeing right now are having temporary hardship. It's not that they need the entire loan to be changed, but they just need, a couple of years in order. That's
most cases of like people get into foreclosure problems in a normal world, not a COVID world, but it's a one-time event that something happens, you lost your job, and you just can't suddenly shift. Oh my God, my industry is wiped out. I have to go to school, get a new credential or something like that, and go get another job. And now I can make my payments again. But there's that gap when they had to go through where, they spent down their savings, and now, I love the idea that, hey, well, you can push something onto the back and you don't have to have this, your house.
Yep. And that's what we're seeing. So we wanted to make sure that we have options, not only for the borrower who can still afford it, but just wants to stop the delinquency. They're at 89 days, not at the 91 where foreclosure can start. But they're just they're tired of the phone calls. Literally just put it on the back of the loan and start fresh the next month. And that's what a lot of people have been doing with the partial claim. But this is now an alternative to help people who truly can't afford the mortgage, but there's no way to get the savings by lowering the rate because the rates are too high in the market, using the partial claim to provide a supplement to reduce that payment is what we're looking at. So that's on the drafting table. The mortgagee letter, the proposed mortgagee letter is out there. So we want feedback from you guys. Any of you who are in the servicing space, let us know what you think about the proposal that's out there.
I find it interesting because there are some people who are just like, hey, if they can't make their payments, screw them. They should have to sell the house and move on. And the reality is a lot of times it is just a temporary situation, and then the borrower will be fine. And why give up an asset? And by the way, rents are high. And so it's not like they're going to save money, or it's not going to be a better situation for them. So ultimately, what is our goal as an industry? That's kind of the decision with this kind of thing, isn't it?
Yeah. I mean, and the good thing is, and what separates this from being 2008 is that we are not in a market that's underwater. That makes a huge difference because that does provide for those borrowers who really have a golden parachute there. Like, for those who were looking to downsize when the kids were going to school and they were like, what's going to get me off of the fence to finally do it? Well, this is the market to do it. But I think, again, we sellers or borrowers have way more options today than they had in 2008. But I think that this is just something for those borrowers who need a little bit of temporary relief to help their payment without going nuclear and having to refi a 3% loan or change the terms of the loan to 7%. It just doesn't make sense for a temporary emergency. So we're trying to figure out how they can keep the low rate for the life of the loan, but help them during this hard patch.
Well, and someone was asking what you thought about the idea that, like during the meltdown, you had to like validate your hardship to get any sort of help or assistance. And this time you didn't. I mean, which works better?
Yeah, well, I will say this. It was, I can say by the numbers, the fact that we didn't have people go over the cliff, it meant it worked. And I was a housing counselor right after the 2008 crash in Baltimore, nonetheless. I was a foreclosure counselor. And I remember how onerous it was to fill out a modification packet. Like, I was there losing it, trying to figure out how to do it. So when I was in the position in order to create the strategy for loss mitigation, we were like, streamline it. Like, let's make it as easy as possible, because we were building the plane while we were flying it. Like, we didn't have time for that. Just wanted to make sure that, hey, look, listen, if you, and at this point, who wasn't impacted by COVID? I mean, some way, shape, or form, everyone has been impacted by it. But we didn't want people to have to go through this whole litmus test and give us a hunk of flesh in order to say, hey, I need help. And a lot of times you're proving a negative. Like, there are people who were just in situations that were like, there was that imminent default that was there. There were people who were like, my paycheck hasn't shown that I had a loss in income, but I've been sick and it's been 2 weeks and I don't have a paycheck that's going to show the loss, but I haven't been working 2 weeks and I can't wait for that to happen. I need you to help me now. Like, those were the stories that we were hearing. So it was really important for us to just say, you know what, we did reach out to the industry. We made sure that we did input sessions first before we did that. We also worked and wanted to align with the other federal agencies, because we didn't want the industry having like the Baskin Robbins of loss mitigation. So we wanted to try to find out where we could align, so that way the industry would have as much similarity among us in order to offer it, so it wasn't so much of a learning curve. But I think that streamlining was important. And I think right now what we're seeing is that a lot of those borrowers who are coming out of forbearance, some people took it just as a safety net because they didn't know what was going to happen. And then a lot of them self-cured and a lot of people did put that money aside and then just put it, paid it back and brought themselves current. So, we're really happy with the numbers. Of course, we're cautious and we're continuing to watch, but overall, I think it's safe to say that we had a successful loss mitigation strategy.
Yeah.
I think it was more than successful. I think it was spectacular.
I do too.
And somebody oh, thank you. Somebody had a question in the chat that said, no, people did have to request the forbearance. They just didn't have to prove the hardship. So they did actually ask for it, but they did not have to prove that they were having a COVID hardship.
Although we did hear a few instances of lenders just putting them into a forbearance and they didn't want it, which was interesting. When you went to refinance them, they're like, wait, what? It says I'm in forbearance. I'm not in forbearance. Yeah, you are, sweetie. Call them. Okay, somebody asked a question: is this monthly MI rate cut applying to pre-existing clients? And the answer is
no. So these were only for new originations. We literally had to start with new originations. We weren't able to grandfather.
Yes.
That's because those loans have been sold on the secondary market and the people that bought them don't want to.
That, and also the premiums collected were already assigned to those loans at the time that they were originated. So yeah, we kind of can't Monday morning quarterback on loans that have already closed and been endorsed.
Of course. Okay, so let's talk about, I've had a few people say that they thought that FHA had come out with a 40-year loan, and it's not a 40-year new loan. It would be a 40-year mod on a mod. Okay, so talk about that for a moment.
Right, because again, we're in an extremely high, well, not high, a higher interest rate environment. So a 40-year AM on a purchase, can you imagine how expensive that would be? But we wanted to make sure that we had a 40-year option in our loss mitigation options when we were working with Jenny for those borrowers who were just really out of options. We just wanted to make sure that, you know, if you did have somebody who was at year 7, left on their mortgage, and the only way that you can help them is to do a 40-year mod, if that's what's going to get them affordability, great. But I think that it was something like 700 people, perhaps, we estimated would be able to benefit from a 40-year mod. It was something like that. It was something like that from a 40-year mod, because all of the other options in our waterfall, like the partial claim that we talked about, like the 30-year mod, like the things that we had above it, the 40-year was pretty much the last option in the waterfall. And that was literally, you know, the Hail Mary that if we just can't save you with any other option, we didn't want to be offering 40-year re-amortizations for people. Like, it's a long time, you know what I mean? And it's expensive. So, but we wanted to have that option that if somebody is either at foreclosure or a 40-year mod is stretching it out for 40 years, can make it affordable for you, even if it's at 8%, then we wanted to give you a 40-year at 8% if that meant you could stay in your home and that's the option that you wanted. Somebody also posed a question about, like, how do you know when it's just time to go? And I think that that's a really important question. And I think that that's why we've really recruited the housing counseling industry to have that conversation, because it's a bit of a sticky conversation for some servicers to have, because they don't want to look like they're steering a borrower into leaving either, you know. But, you know, and you know, CFPB has weighed in on this as well. And they did a blog, I believe, a video blog that basically said that, you know, does it make sense for you to sell? And that there are some situations where, you know, that is the best option if they're sitting on tons of equity. Especially do that instead of having ostrich syndrome and just not answering the phone and the sheriff comes. Like, yes, sell before you get there. I think that was more the message. Don't strip your equity if you have an alternative by selling. So to answer that question, I think that housing counselors are big in that conversation. And I think that also, you know, what we used to do when I was a housing counselor, the first question we would ask is, do you want to stay in your home? Like, that's where we started, because sometimes people haven't even thought, like, what do I even want to fight for this? But until you give them that option that you don't have to stay here, you know. Yeah. You know, and I think once you give them that option, they're thinking, oh, that's, you know, there is equity in my house. I have been here for 17 years. And perhaps I'm sitting on X, you know what I mean? Yeah. And you present that,
sell it and walk away and
just start fresh. Or, you know, for some people, you know, and as Audrey was saying, rents are extremely expensive, but people who can cash out with significant proceeds they are becoming competitive in the rental market, because they can pay their rent ahead for 2 years. Like, so some of the people who were either in the purchase market who were getting outbid are taking their down payment money and are paying their rent, you know, forward for 2 years with a private landlord, and are beating out people who can't. So they were taking their cash from the purchase market and becoming more competitive in the rental market. So, but we wanted to make sure that, you know, that people knew that selling is an option, and is definitely a better option than waiting for the sheriff to knock on the door and take your house with your equity.
I've seen people do that where they actually rent and they'll pay the whole 2 years right up front. And
yeah, they'll just pay it up front and use their proceeds, so that way they've stabilized their housing costs at least for the next 2 years. Like we've been hearing that too.
That's not stabilized. You have no payments for 2 years.
No payment.
Oh, okay, but you have to have great faith that that your landlord is not going to sell that place, that it's not going to burn down and be uninhabitable. You know, there's a million reasons to not think that's a good idea, but I get it. Like if you can't get in any other way, the rental market is moderating too, which is good news. I mean, those rents have come way, I think that topped out at 11% growth year over year, and we're way off of that, thank God. And so, and that's partly what's helping our inflation numbers is, you know, it's what 42% of CPI is shelter. So it is, or core. So anyway, so that's all starting to moderate and it's helping. But if you can avoid paying your landlord up front for 2 years, I would highly recommend that. We had our favorite smart aleck Dirk made a comment. I doubled my production this year. Last year I closed 1 loan. This year I've closed 2. So, I love the trajectory,
Dirk.
Exactly.
Yeah. Next year it'll be 3 or 4.
Yeah.
Hopefully one of them was an FHA loan.
Well, I'm just wondering when they're going to roll out some products for loan officers who are sucking wind after the last 2 years and probably couldn't qualify for anything if they needed to, right? So it's rough out there for
but can I say this though, really quick, Audrey? We did roll out a policy, and I don't know if I talked about this the last time that I was on with you guys, but about calculating effective income. That for some borrowers who were negatively impacted by COVID and had a temporary loss of income, we rolled out a policy to make sure that that gap in employment wasn't held against them. So there's actually a mortgagee letter out there for that. So I just wanted to let you guys know that if you do have a borrower that, you know, didn't have any income for a certain period of time during the course of the pandemic, there's a policy for that in order to make sure that you know, that their averages aren't hurt because of that.
Yeah. Great. Okay, so 6 months ago, you guys clarified dual income, and so the ability to do the loan and do real estate at the same time. How's that going? What are your thoughts on that at this point, 6 months in?
Oh, yeah.
Yeah, we haven't heard anything major with any problems. I think also because there were other agencies, even on the state level, that had regulation in place to make sure that there wasn't any abuses there. And we have RESPA there as well too, right? So, I mean, with that being said, what we didn't want to do and what we saw becoming a difficult economy was to make things more difficult for people who may be trying to seek other sources of income. So we just didn't want to be you know, to make things harder for borrowers who were trying to make it, especially when we know that the mortgage industry was being hit too with the rising rates, and you know, people needed this, you know, people need to make a living too. Loan officers need to make a living too, but we just didn't want to be in a position where we were obstructing that and making it difficult for them to create a living. So we felt that there were enough protections in place outside of HUD to help regulate that, for us to be able to make that decision. But we haven't heard anything of, you know, any abuses or anything like that to my knowledge. I haven't heard anything.
A lot of loan officers still don't know that they can now do real estate and loans at the same time.
Yeah. I've had a real estate license since the 90s, and I've never done my own real estate transaction. I mean, I'm in California. I'm very concerned that I would be held to a higher standard should something go wrong, you know, and I don't do real estate every day. So I don't feel like I'm enough of an expert. So I don't do that, but there you go.
And it's more so the need to disclose if that's the case. You know what I mean? So I think that it was just a matter of, you know, if you do have a license, just disclose that you do. And I mean, and if that's the case. So, I mean, if someone said do loans or sell houses, it's a conflict of interest. But like you said, with Audrey, for example, she has a license. She should still be able to originate even though she has a license. You know what I mean? So with that said, we
an option.
Yeah, we wouldn't want Audrey to be in trouble because she holds a license, even though she's not utilizing it. We don't want her to say, oh, you can't do FHA loans because you have a license. So this doesn't mean that you are literally representing both sides of the transaction. It just means that you disclose if you are doing that, if you have that dual employment.
Grant wants to be my realtor. Thanks, Grant. That's really okay, so because we just can't get enough of credit around here, let's talk. We've had count them, two recently sessions on credit, because there's so much that is being discussed, so many potential changes coming down the road, and how does that all fit together, and blah, 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 blah. So tell us how FHA is approaching all of this and what you're, how you're dealing with it.
Yeah, so we're continuing to have conversations because we know that any change in the credit box, whether it's with us or with any of our friends out in the mortgage industry, it all has a ripple effect. So we're continuing to have like working groups and conversations, with, FHFA's decision to change their credit scoring model. Like we're engaged in those conversations with them regularly, and just to understand kind of where they're moving, and what that means for people who are originating loans for us. But I think that we're just making sure that we're fully aware and read into what's going on to make sure that it's not intrusive, and that we're making sure that it's not difficult for us to you guys to continue serving folks. So we're continuing to have the conversations with them just to see where they are, and to make sure that that we are in alignment to the point that it makes sense. But of course we know that FHA borrowers are a different type of borrower. They have a different type of need and they need different considerations, because they are not your conventional borrower. They don't have the resources, and we know when they come through the door that a lot of them are having credit issues. So any changes to how we evaluate credit, we're very judicious with that, but we are also making sure that we're having conversations with them to see that anything that goes on over there that we're aware of, if there are any changes that we need to make in order for you guys to continue business. So we're still talking with them and seeing where they're going to land on it.
Do you think there's any possibility you'll stay the same, and then they'll go off and use Vantage 4.0 and FICO 10T?
Well, I'm not sure because I haven't been in those conversations recently.
Okay.
So that's more in the policy shop, but I can circle back with you guys to see if there's anything publicly that I can share, and I'll let you know, Audrey.
Yeah, just keep us posted on what does transpire. We don't have to guess. It's just so daunting, and I just keep thinking, okay, can someone please show me how many people this will benefit, what the cost is, and then can the industry bear the cost right now because of this big, humongous shift? Because again, it gets trickled down to the borrowers eventually. And is that what we're looking for? And is it really a big enough benefit to people to make the change? And so, I mean, and I'm not saying I know the answer. I'm asking the question. Like, I just want to make sure people are thinking about that, because I feel like there is a segment of our industry, and a lot of the regulators and legislators, and it's all great in theory, but once you translate it to the ground, it's like, it's a lot for the borrowers. They're paying for it. Now we've got to think, okay, so you've always had a 780 score, but you always thought that your internet provider sucked and you never paid them on time. And if that thing lands on your credit report, that changes everything. And, how do we prepare people for this, right? So, that's what we're concerned about. How do we prepare our borrowers, get them ready for what potentially might be coming, especially if you do a 2-year look back on a credit report and all of a sudden, boom, there's new information. Holy guacamole.
Right, because a late payment on your AT&T bill doesn't hurt your credit score today, but that same late payment today will hurt your Vantage score 2 years from now when you pull your credit.
And that was kind of the conversation we were having when we were incorporating positive rental history into our automated underwriting when we did that in September, because everybody was solving for how do you put rent on the credit report, and as the CFPB brought up, it's like, okay, well, if you pull one thing, just understand that you're going to be pulling everything, which means that there might be some borrowers, for example, or applicants who didn't necessarily maybe they were late and paid on the 7th instead of the 5th or whatever, you know what I mean? And we wanted to have an opt-in structure. So that way on the application, the only people doing it were raising their hand saying, I've paid my rent on time for the last 12 months. And that allowed us to kind of circumvent a lot of waiting for the rental to be reported. But also the reason why we did this, because the majority, well, I won't say the majority, but a lot of our borrowers have private landlords that are mom and pops that would never contribute to reporting their rent anyway. So we wanted to make sure that there was something in place for those borrowers, and even the borrowers who are living with their mom and dad, like who are paying rent to their parents. We wanted to have something for them, because as long as they could show the transfer over the last 12 months, it was more than $300 and they were first time home buyer and they had a 620. If they could do that, then that would serve as justification of paying their rent on time and, and having a lease with their parents. So, but we were trying to make sure that we didn't necessarily, at least for what we were trying to achieve, is to make sure that we could allow rental history to count without having to go to the credit report, and all people, even if you didn't need positive rental to help qualify, we didn't want them to get pulled into it and be hurt. We wanted an opt-in structure, which is why we went the way we went.
Opt-in is so much better than opt-out, in my illustrious opinion. So Guy said that Audrey should do the escrow and be a housing inspector too. Dirk says that anyone who lacks experience and represents themselves in a transaction has a fool for a client. Yep. And Michael says, impressive presentation, affirming to hear such clear, intentional problem solving. Yes, Julian, we love you. He said, Audrey, can you share Julian's email contact with me? I have an idea I'd like to put on her drafting table. Can you share your email?
Sure.
Do you mind that?
I'll drop it in the chat, guys.
Perfect. That sounds good. And I got a text from somebody asking for the discount code for Mortgage Innovators, which I will send to you as soon as we wrap this up. I would be happy to. And Julian, last time that you were on, there was a major soccer extravaganza going on. Do you remember that?
Yes, because I remember the cheers were happening in the background, and you were like, I don't know if you guys can hear, but the World Cup was going on the last time that I was on. I think that was in November, I think.
So I thought that it would be good to share that they just don't fight wars like they used to. In 1967, the Nigerian Civil War ground to a halt for 2 days because both sides wanted to watch Pele play soccer. I mean, is there ever been a better excuse for stopping a war for a couple of days, right? I thought that was crazy. Crazy. All right. So tomorrow, kiddies, we have, again, Fed minutes and PPI. It'll be a market mover, no doubt. We have, I wanted to say next week, we have Katie Delasto, who is going to share with us 101 lead generation ideas. Do you get that? That means
101.
That's sunbathing and actually
rapid fire.
What?
Rapid fire. That's,
Okay, yeah. Just to be clear, I am not promising we're getting through all 101 of them. And she does have a coaching program, which I've heard great things about. So maybe that's where you learn the rest of them. But we'll get through as many of them as we can. I've clarified with her. I'm like, so just to be clear, we're going to actually talk about the 101 ways. Yes, we are. Great. The week after that, we have Dave Stevens, who we absolutely love. He used to be head of FHA. You weren't there then, were you, Julian?
No, but he actually hired me at MBA. So when I was at the Mortgage Bankers Association, he was my CEO and president. I was hired underneath Dave's tenure at MBA.
Wow.
So
I don't know if you love him as much as I do, but man, that guy.
I thank him for giving me a job. Thank you for the job, Dave.
We'll tell him he said so.
Okay, look, Grant says, listen to this, Missy. Thank you, Julian, for being such a balanced and wise person in a key role. Oh, he said nice things. He said thank you to us too. That was very sweet. Julian.y.joseph@hud.gov. And oh my God, people are just effusive with their compliments today. So all right, there we go. So Dirk wants to know if that'll be a 10-hour call. Yeah. And I just got the CFPB is coming back on at the end of July, which we love Mark McCardle. He's so great. We do that live, guys. We don't record it. It doesn't get posted. It is, but it is always really interesting. And so we have a lot to look forward to. I'm excited. So Julian, just to wrap up, is there anything else you want to share with us before we call it?
This is amazing. This is awesome. Thank you guys so much for just doing what you continue to do. I think I told you this the last time. Supporting FHA is mission-driven work, and we would not be who we are at HUD without you guys. So please continue to support us, and we will keep listening to you. So please keep the candid feedback.
When I call her, she comes, you guys, even when she's got a shoulder in a sling. So thank you so much for being here today. Look at her. Wow. We will see you next week at 2 p.m. Eastern time, 11 a.m. Pacific time. Have a great week, guys. Bye.
Thank you much.
Bye.